It's late 2019, and a deadly silence fills NIO's Shanghai headquarters. Just 1 year after its flashy IPO, the Tesla of China is on life support. The company's cash reserves have fallen so low, they can barely cover one more quarter of bills. Its stock has cratered from double-digit highs to barely a buck. Rumors of bankruptcy swirl. William Li, founder and CEO, paces the hallway, clutching his phone. A banker on the line warns that funding options have all but dried up. In a conference room, trophies from NIO's Formula E victory gleam under fluorescent lights, mocking reminders of a time when investors called this company unstoppable. Now the only question left is whether NIO will still exist by spring. Li whispers to a deputy, "If we don't find help this month, it's over." Just 5 years earlier, China's tech elite had hailed Li as a visionary. Backed by Tencent and Sequoia, he launched an electric supercar prototype called the EP9, 1,341 horsepower, a Nürburgring lap record, and a $1.5 million price tag. The stunt electrified the press. Overnight, NIO went from unknown startup to global headline. In September 2018, it listed on the New York Stock Exchange, promising to build premium electric vehicles for China's booming middle class. Wall Street loved the narrative. Within days, the stock doubled. For a brief, dizzy moment, NIO was worth $12 billion while having delivered only a few thousand vehicles. Behind the glamour, the burn rate was brutal. NIO offered lavish owner clubs, free lattes in members-only lounges, dedicated customer concierges, and a plan to blanket China with robotic battery swap stations. The bill for all that hospitality arrived in 2019. Battery pack fires forced a recall, sales slowed, and quarterly losses topped $300 million. By autumn, investment houses were dumping shares, citing reckless spending. NIO's cash runway shrank to weeks. Employees braced for mass layoffs. Suppliers stopped shipping parts. 18 cities turned down William Li's desperate plea for capital. On the 19th call, Hefei's local government said yes. In April 2020, as COVID lockdowns crippled China's auto market, Hefei wired nearly $1 billion into NIO's empty coffers. In exchange, the city took a quarter stake in NIO's China subsidiary and demanded factories relocate there. Critics called it a bailout. Internally, executives called it a defibrillator shock. The money hit just in time to cover payroll, restart production, and launch the EC6 crossover. Against all odds, the patient's heart started beating again. Investors smelled resurrection. Deliveries rebounded, and by early 2021, NIO's shares screamed past $60, briefly valuing the company north of $100 billion, more than Ford. NIO had cheated death and was hailed as a phoenix. Yet survival bought time, not certainty. To justify its new valuation, NIO doubled down on its most radical idea, battery swapping. Where rivals pushed faster charging, NIO bet that drivers would prefer a 3-minute battery exchange to a 30-minute plug-in. Each swap station cost hundreds of thousands of dollars, but it allowed buyers to purchase the car without the battery, slicing roughly 10 grand off sticker prices. Most owners signed up for a monthly battery rental fee, creating a recurring revenue stream and tethering them to NIO's network. By late 2023, the company had built more than 2,000 automated swap depots across China and Europe, an infrastructure feat nobody else attempted at scale. Videos of robotic arms sliding fresh packs under SUVs went viral, cementing NIO's image as the convenience king. But convenience collided with capitalism when Tesla slashed China's prices in early 2023. Elon Musk triggered an all-out price war, forcing every brand to discount or die. NIO had prized its premium aura. Now it chopped 30,000 yuan off every model and, in a painful concession, ended free battery swaps for new buyers. Margins evaporated, quarterly losses ballooned, and the stock plunged back to single digits. While fighting on price, NIO also faced geopolitical crossfire. US regulators threatened to delist Chinese companies that refused American audit inspections. In 2022, NIO landed on the provisional blacklist. The share price wobbled again. To hedge, NIO rushed secondary listings in Hong Kong and Singapore. Diplomatic negotiations bought breathing room. But the episode reminded investors that politics could pull the rug at any moment. William Li responded with expansion on all fronts. He greenlit 2 new sub-brands. First came Onvo, mid-priced family EVs aiming straight at BYD. Then Firefly, tiny city cars built for Europe, scheduled to enter 16 foreign markets within a year. Inside NIO, Engineers raced to finish a 150 kilowatt-hour semi-solid battery, promising a 1,000-kilometer range, while software teams rolled out autonomous driving updates and even a NIO-branded smartphone that doubles as a car key. By spring 2025, NIO was delivering roughly 23,000 vehicles a month, a 50+% jump year-on-year. Yet profit remained elusive. Last year's net loss topped $3 billion, the worst in its history. Analysts sliced price targets to $5. Abu Dhabi's sovereign fund had poured $3 billion into NIO, only to watch the stake sink underwater. Even so, Lee set a bold goal: double deliveries again and hit break-even by year-end. Or he warned his team, our business model fails. Today, NIO's future balances on a knife edge. On one side, a cult-like customer base, unmatched swap infrastructure, and government allies who see NIO as a strategic trophy in the EV arms race. On the other, relentless price pressure, mounting debt, and a market awash with competitors from Tesla to BYD to Huawei-backed startups. The next 12 months will likely decide whether NIO becomes a sustainable global brand or a cautionary tale of hype and overreach. William Li has steered his company through record lapse, fiery recalls, a near-fatal cash crisis, a billion-dollar bailout, and a brutal price war. He once said, NIO was created to take on impossible challenges. The road ahead may be the toughest yet. If NIO can scale its new brands, squeeze costs, and finally turn a profit, it could rise again and embarrass every analyst who wrote it off. If not, the history books will list NIO alongside DeLorean and Fisker, brilliant visions that burned too bright, too fast. For now, the race continues. Factories in Hefei hum day and night, swap stations click and whir across China, and die-hard NIO owners sip lattes in glass-walled clubhouses, still believing their brand will outrun the giants. The rest of us watch, wondering whether this electric vehicle phoenix has one more resurrection left, or whether gravity will win at last.